If you've ever wondered where money actually comes from, you're not alone. Most people assume that banks are basically giant vaults where they store everyone's deposits and then lend out a portion of that cash to other people. It's a nice, tidy story that makes intuitive sense, except it's completely wrong. The reality is far stranger and honestly a little bit like magic, if magic were regulated by the Federal Reserve. Today, we're diving into how credit is literally created from nothing and why understanding this changes everything about how you think about money. Here's what actually happens when you take out a loan. Let's say you walk into a bank and ask to borrow $10,000. You might imagine the bank going into its vault, counting out your cash from other people's deposits and handing it over. But that's not what happens at all. Instead, the bank just types numbers into a computer. Seriously. They create a new deposit in your account that says $10,000 and simultaneously create a liability on their books that says you owe them $10,000 plus interest. That's it. The money didn't exist before, and now it does. This is called fractional reserve banking, and it's the foundation of our entire monetary system. Banks are only required to hold a small fraction of their deposits as actual reserves, usually around 10%. Though this has changed over time. The rest they can create as new loans. So when you deposit $1,000, the bank can turn around and create $9,000 in new loans, which then get deposited elsewhere, and those banks can create even more loans. It's credit creating more credit, expanding the money supply with every transaction. Here's the thing. This system works as long as everyone doesn't try to withdraw their money at the same time. That's what a bank run is. If people lose confidence and everyone rushes to pull their cash out, the bank doesn't actually have it, because most of it only exists as numbers on a screen backed by people's promises to repay loans. This is why governments created deposit insurance. In the US, the FDIC insures deposits up to $250,000 per account, which keeps people calm and prevents bank runs. Now you might be thinking, wait, if banks can just create money out of thin air, why can't they create infinite money? The answer is regulations and risk. Banks need to maintain certain capital requirements and reserve ratios. They also need borrowers who are likely to actually pay back their loans. If too many people default, the bank takes losses on money they created but will never get back, which can threaten their solvency. The Federal Reserve controls this whole system by setting interest rates and reserve requirements. When they want to stimulate the economy, they lower interest rates, making it cheaper for banks to lend and for people to borrow. This creates more credit, which means more money flowing through the economy. When they want to slow things down and fight inflation, they raise rates, making borrowing more expensive and reducing credit creation. Here's why this matters for you personally. Every time you take out a loan, whether it's a mortgage, car loan, or credit card debt, you're not just borrowing existing money, you're participating in the creation of new money. And here's the uncomfortable part. You're paying interest on money that didn't exist until you asked for it. The bank created it with a few keystrokes, but you're paying back real value over time through your labor. This isn't a conspiracy or a scam, it's just how the system works. And understanding it helps you make better decisions. It explains why debt is so profitable for banks. It explains why central banks are so focused on controlling interest rates. And it explains why during financial crises, credit can dry up almost overnight. Banks stop lending, money stops being created, and the economy contracts. The move here is to be intentional about the debt you take on. Since you're essentially paying interest on money that was created specifically for you, make sure that debt is working in your favor. A mortgage on a home that appreciates or a loan for education that increases your earning power can make sense. High-interest credit card debt for things that lose value immediately. That's you paying real money plus interest for something that was created from nothing. The monetary system is weird and counterintuitive, but it's also the water we all swim in. The more you understand how it works, the better equipped you are to navigate it. If you found this helpful, subscribe for more content that breaks down how money actually works. Let me know in the comments what financial topic confuses you most.